Thank you. Everyone should have something like this on their in their stack of stuff now. I dropped them off during while everybody was at lunch. So as long as everybody has one of these, that'll be fine. Well, trading to many people is compared to all kinds of activities. At the extreme, people talk about trading as like going to war. And maybe probably at a much lighter extreme, they also talk about it as being just a competitive game. Well, trading to me can be thought of as something similar to going fishing. And I have two stories for you to support my explanation of why I think trading can be like going fishing. The first story is back when I was around 10 years old. I saved up all my allowance, come to the total of $10, probably took me a year, and I went out and bought my first fishing rod and reel. I remember it really well. It was the Zebco 202. And I was really into this fishing rod and reel. I used to take it apart and keep it clean. I'd sit out in my backyard and I'd practice casting, and I could hit anything in the yard with the little weight that was on the end of the line. I could loop it over a tree branch. Anything I wanted to do with this thing, I thought I was really right on. Well, one day my mom says, "I'm going to take you and your two younger brothers fishing." Well, I was really excited because we didn't live on a lake, and I didn't really get to use my fishing rod and reel very much, so it was going to be a big deal for me to go out fishing. Well, my mom took us to Lake Washington, and for those of you who are not familiar with Seattle, Lake Washington is this very large lake that borders Seattle on one side and what has now become Bellevue, Washington on the other side. Well, my mom takes us down to this fishing bridge that's at the south end of the lake. I remember it was a really warm, still day, and she helped me get my little salmon egg and put it on this little hook, and I had a little float on the line. And I remember leaning back and casting this out into the lake and watching everything kind of come to a still. And then I looked up, and I looked across Lake Washington, and I said to myself, man, this lake is about 2 miles wide. And I looked to the north, and Lake Washington is about 25 miles long, and it's hundreds and hundreds of feet deep. And I said to myself as I was standing there, I says, how in the world is any fish going to find my little hook with this smelly little egg on it in this gigantic lake? Well, I think as a new trader, that's a very similar situation for most people. They go out and they buy their computer, they get some software, they pick up a few books, they start to look at the Wall Street Journal, and they say to themselves, how in the world am I going to become somebody who's successful at this? I mean, there's just so much information, there's so many markets, there's so much technique, all kinds of computer software. The whole thing can be as equally overwhelming as it was for me as a little 10-year-old guy trying to catch his first fish. Well, I didn't catch any fish that day. I was pretty accurate on no fish did find my little salmon, but it was a great day for me, and I remember very fondly my mother doing that. Well, now let's jump ahead about 15 years. Later, I'm putting myself through school at the University of Washington, working nights as a Teamster for Sea Land Service. Not a fun job. I wouldn't recommend it to anybody. But one of my, we'll call him a brother Teamster, was a guy named Jack. He was about the same age as me. We were both in our early 20s. Jack was a tremendous athlete. Jack was all-star high school track, football. He was all-state. He went to, I don't know what university, but he had a full-ride scholarship for track. And in fact, he went to the Mexican Olympics as a number 4 alternate for the javelin. That's how great of an athlete this guy was. Well, when I knew Jack, Jack had one passion. Jack loved steelhead fishing. He just, every weekend, he went down south part of Washington State to spend his entire weekend steelhead fishing. Now, if any of you have done any steelhead fishing, you'll know there's a number of things that are kind of interesting about steelhead. One, great tasting fish. Boy, you can do anything you want with these fish, and it just tastes great. Two, they're a great sport fish. They're big, they're strong, they're angry. You hook one on your line, that fish will come bolting out of the water, and it'll just run your line for hundreds of yards, and you'll be doing everything you can to keep them on. You'll be climbing around trees and running up the bank trying to stay with this fish. Fish will just turn around and bolt the other way for hundreds of yards. You'll spend half the day trying to wear them out before you can finally land them. Now, the final thing that's interesting about steelhead fishing ties in with steelhead fishermen, in that I think it's like 90% of steelhead fishermen out there have never caught a steelhead fish. They go out there and they fish and they enjoy the wet, Northwest River, standing in these ice-cold rivers, but they never catch a fish. Well, here's my friend Jack, though, who is upset if he doesn't at least get one on every weekend that he goes out. So Jack one time says, hey, do you want to go steelhead fishing with me? And I said, sure, I think it'd be fun. I'd like to do that. So the night before we're going to go fishing, I spend the night with him. And instead of, watching movies and having a few beers, we're sitting around tying up tackle. He used two techniques for his fishing. The first one was for spoons. And he explained to me that the steelhead, he says they like to rest for a while in deep pools around large rocks. He says if we come across that situation, we're going to cast these spoons in there, and if a steelhead sees one, he says they'll just attack that spoon, and it'll come right out of the water, and we'll just hook them, and then we'll spend the rest of the afternoon trying to get them landed. His other technique that he used, I don't remember the name of it now, it involved this like jig with a little lead weight on it, and a line that went up for your leader, and this little float of yarn with a little hook on it. He said this is for areas of rivers where the water's moving along and a little bit shallow. He says as the steelhead work their way forward, he says we'll toss this out there and be cranking it slowly back in, and we'll feel the lead weight bouncing along the rocks. And he says, and if you feel suddenly it stops, chances are a steelhead has stopped this in its mouth, and then you want to set the hook, and you'll know right away if you've got a steelhead on or not. But that's what we spent the first night doing, was tying up dozens of each of these two ways of fishing. Because Jack kept saying, don't have your line in the water, we're not going to catch any fish. We're not going to be standing around on the riverbank tying up leaders and tying up our spoons. We're going to do everything right now so that when we get there for fishing, we're going to have our lines in the water and we're going to be fishing. So we go to the first spot, and it calls for spoons. So we cast for about 20 minutes, spend some time in there trying to see if anything happens. Jack goes, okay, that's it. I went, that's it? And he said, yeah, we're leaving. And I said, we're leaving? Why are we leaving? He goes, there's no fish here. And I went, okay. So we pack up and jog to the van, go to the next spot, and this one called for, it was a little swifter moving river, so we used those techniques. After about 20 minutes, nothing's happened. He says, okay, we're leaving. And I went, we're leaving again? He goes, yeah, there's no fish here. Well, we basically were not fishing from my standpoint of how to fish. We were hunting down the fish. And that was Jack's technique. I mean, he did not wait around for the fish to come to him. He was going to go get the fish. Now, what does this have to do with trading? Well, Jack prepared. Every night before he went out fishing, he got everything all set up so he did not have to be thinking about doing things during the day of his fishing. Everything, he had all his lines set up, he had his bait set up, he had his map set up, he knew exactly what he was going to be doing the next day. And a good trader can do the same thing. The night before the markets are open, you set up what the trades can be on a what-if scenario for the next day. Jack specialized. Jack only used two techniques for fishing. He wasn't bouncing around from week to week saying, well, I read an article in one magazine that said, this looks like a good way to fish, and I used a different bait the next week. He specialized and mastered what his technique for fishing was, and then he executed. There was no question when he went out every time for fishing, he did the exact same thing for all of his fishing. And those are the three things that I think that are very applicable to becoming a good trader. It calls for preparation, calls for specialization, and it calls for execution. So now I'd like to go ahead and move on and talk a little bit about some trading ideas. And those of you who read the September 1995 our magazine, Stocks and Commodities magazine, you'll know that Robert Kraus had an interview in that magazine. And in it, Robert talks about that there's two key modalities towards trading. One is analysis, and the second one is taking action. So the first thing I'm going to do is I'm going to talk about some ways of doing analysis for the markets, and then I'll move on to how we can take that analysis and turn it into action. You're going to find that what I have to talk about dovetails very closely to what Robert says. Robert has had a very great influence on me, and his methods I take wholeheartedly, and I've been using them with the very techniques that you're going to see here. And one of those methods, talks about having this valid trading plan that's been back tested. Trading and investing for some strange reason it's really interesting. If I recently had some oral surgery done, and I go into my doctor, and she says to me what she's going to do. And she says that she has done a lot of these, and there's been maybe just a handful where there's been some other problems where it didn't work out. But she gave me a great deal of confidence because she's probably done anywhere from 500 to 750 of these particular procedures. She did not say to me, well, I normally would do this, but last night I got this tip from a friend of mine that says that this might work better, So in other words, that's how you need to look at trading. You don't want to do it on tips. You don't want to be jumping from method to method. You want to use the same sort of professional attitude that you would expect if you went in for some surgery. You want that person to be doing the exact same thing every time. Okay, so let's go ahead and talk a little bit about some methods of analysis. And then, okay. On your first chart, I have just some synthetic data. And I want to just kind of show a basic idea here. And this is just a simple moving average that everyone learns first about trading. The trend is your friend. And as you can see here, as prices move up and move down and then up and sideways and up again, that this does a nice job of tracking the trend. And in fact, if we change charts here for just a moment and look at Intel, this is daily bars on Intel with a 10-period moving average. A moving average is commonly called a filter from an engineering or a mathematical standpoint. And they call them filters because they filter out noise. If you look at what the nature of the moving average, you can see that it's a very smooth line compared to what the daily activity is. And the reason that happens is because a 10-day moving average is simply taking the last 10 days' prices, adding them together, and dividing by 10. And so what it does is it removes the noise about the trend. It removes, and from a more mathematical standpoint, it removes what we call high-frequency noise while letting a cyclical component that is of a longer time frame through. So that's what's causing the moving average to move up and down, to move the way it does, is because the cycles that are longer than what the moving average is filtering out are causing the moving average to reflect those cycles, and the cycles that are shorter than what the moving average is filtering out are suppressed. And so we call this a filter. Now, if we go back to chart 1, though, there's a problem with moving averages in that moving averages, by their very nature, introduce lag. If you look here, you can see point A is where the market peaked, but the moving average did not peak until about 8 or 9 bars later. Then the moving average turned down after the market had peaked. The same thing with going down here at points C and D. You can see that the price action bottomed and the moving average bottomed afterwards. So technicians often say to themselves, well, I'd like to also, besides a moving average, I'd like to have something that might do a better job of telling me when a peak or a bottom is happening. And technicians look to momentum indicators for that. A momentum indicator is different from a moving average in that, again, a moving average is just simply summing a look-back period of prices and then dividing by that look-back period to come up with an average price. A momentum indicator takes the difference between two prices. A one-day momentum indicator, I guess their 2-day would take the difference between today's closing price and yesterday's closing price. A 10-day momentum indicator would take the difference between today's closing price and the closing price of 10 days ago. So now what happens? Let's say the market is going up like this, and then back down again and up again. If you were to plot just the difference between each closing prices. And we were plotting this difference on a momentum difference here. It would immediately, the first day's price is up here like this. The second, and this was 0. The next day's price is at the same level. The next day's price is at the same level. The next day's price is at the same level. These two prices here are equal, so this would drop back down to 0. And then when the market turned down, here, this indicator would drop below 0. So in effect, a momentum indicator can become a leading indicator. So let's look here at a rate of change indicator, which is one of your more standard indicators. Rate of change is simply taking today's price, and in this case it's a 10-day rate of change, minus the price 10 days ago, and then I believe this one is dividing it by 10 to come up with a percentage change. That's not going to be important here, but what's important is you can see on page 3 here how this first part of the period from to the left of May is not important because there wasn't enough data for it to be up to speed yet, so we won't worry about that. But notice how as we get down here on May 1st, as the market was beginning to slow down, the momentum indicator began to level off. Now this was evidence that the market was losing momentum because as the market got down to be at the bottom, it was no longer the difference between today's price and the price, say, 3 or 4 days ago, was no longer decreasing. It was now becoming even. As the market begins to go higher, the momentum indicator turns up. Well, what's important here is you can see how the bottom here on the momentum indicator was coincident with the bottom in the market. Likewise, as the price continues to go up and then begins to level off again, the momentum indicator as a coincident indicator begins to level off, and as the market begins to go sideways, the momentum indicator begins to fall back down because the market has lost its momentum. The problem with momentum indicators, though, is that they will forecast 6 out of 4 tops and 6 out of 4 bottoms. That is, the market may lose momentum, but it's not really a top or a bottom. It's only a leveling off period. Now, in most people's trading packages, they have lots of different oscillators or momentum indicators. Oscillators are the same thing. My favorite one is relative strength index. Here we have a 14-period RSI on the T-bond contract. I've been following RSI ever since I probably got my first computer program. RSI, the way it works is RSI calculates today's closing price versus yesterday's closing price. If it's an up close, RSI will take that value and put it into the numerator of a ratio. If it's a down close, RSI will put a 0 in the calculation of the numerator and replace that and use the difference for a down close in the denominator. Ultimately, what happens is RSI is a ratio that tracks the number of up closes versus the number of down closes over your look-back period. And the number is normalized so that it has a scale between 1 and 100. The interesting thing I think about this chart is something that you'll see is kind of new from what most people read about RSI. As most discussion about RSI is that RSI is used to recognize overbought and oversold conditions. What I'm recommending that we do is we look at RSI as an indication of trend. In this first example, notice how whenever the RSI was above 50, from this point here to this point, the market tended to trend higher. It momentarily was below 50 at this point and then went back up again, and then throughout the rest of this trend, RSI was never below 50. This, to me, is a very solid sign of a strong market if the RSI is greater than 50. Now, RSI also, while it is a detrending tool, if there is a strong trend present, RSI will reflect that strength of that trend by the fact that RSI in a bull market will rarely drop below 40 and 50, as I show here with this. It's the same chart, but I have a little more explanation on the text. And the reason this is because while RSI is detrending the market, the longer-term cycles still come through and are shown by the RSI staying persistently above the 40 to 50 level. So what I'm saying here is that oscillators in general, you can find this with your favorite oscillators too, that is, if there's a strong trend present, you can abandon the normal oversold level being in the 20 to 30 level and overbought being in the, say, 70 to 80 level. There will be a shift in the oversold levels when there's a strong uptrend. For the RSI, I find that on a 14 period, oversold is around the 40 level. That is, if you're in a strong bull market, you will not drop below the 40 level. And likewise, if you are in a bear market, here are the bonds here, RSI stays well below 50 throughout most of this downtrend. And when it does momentarily go above the 50 level, it only reached 55. So in a bear market, the overbought level is 60 on the RSI. Now it turns out that we can use this similar concept in different time frames. The next chart I'm going to show is a weekly bond chart. Now I did run into a problem with using the same period look back for like a weekly on the RSI. I found that it was more effective identifying the trend on the weekly chart if I used a 7-bar RSI than the 14-bar RSI. But we can see the same thing happens here. Here in after July and August, when the RSI went above 50, you can see that there was a very strong trend in place for a considerable amount of time for the rest of the year on the weekly bars. Likewise, when the RSI dropped below 50, you can see that we had a fairly strong trend to the downside using the weekly RSI. Right, but I'm not, divergence is not going to be really a part of this plan in here. Right now what I'm doing is I want to show how on different time frames we can use RSI for identifying what the direction of the trend is. Because again, the cyclical component here, that is the amount of downward pressure is so great that the RSI is staying persistently below 50, or when the buying pressure, the cyclical component is so strong, RSI stays above 50 on a persistent basis. Likewise, here's an intraday chart of bonds. This is some recent price action, and you'll see it here in a few minutes. These are 40-minute bars, and you can see that during the intraday, on each of these single days, that there was a tendency for the market to trend as long as the RSI was above 50. Interestingly enough, you'll see in a few minutes, but on this during this particular time period, the daily RSI was above 50 the entire time. So notice how on the 17th, how the RSI on the 40-minute bar here hit 40 and then moved higher. So what I want to do is establish now the issue of using multiple time frames. Go ahead.
I just wondered, maybe 5-minute charts.
40-minute.
Use like a 14?
Oh, yes, I do, actually. I use pretty much, I use 14 for everything. If I was looking at 5-minute bars, I would be looking at it at the 14 level as well. So what I'm proposing here now is that we can consider using RSI. In this particular case, if the RSI on the daily bars is above 50 and the RSI on the 40-minute bars was to drop down to the 40 level and then turn back above 50 again, you have the trend of two things going for you. You have the trend of the RSI and the daily momentum going your way, and you'll have the trend of the RSI on the intraday charts going your way as well. And so to me, trading with the trend of momentum is like having the wind at your back. Now, one of the things Robert's talked about is identifying support and resistance zones for your trading. We've established in here an indicator for the direction of the trend, and we even have some supportive evidence of the oversold in an upward trend being at the 40 to 50 level, and overbought in a bear trend as being at the 60 level. So the two things that are important here is that our trend is being defined by RSI being above 50 or below 50, as well as we have a backup, that is if the RSI does drop below 40 on your own time period, but the daily bars, like if you're trading the 40-minute bars, but if the next higher time period was above 50, chances are that 40 period is going to hold. Now, we all know that markets tend to zigzag. Sure.
How do you know whether you're in a bear or a bull market, and is that applicable to the market as a whole, or are you talking about those terms in relation to that stock in particular?
Just with that stock in particular, if you're trading daily bars, and if you looked at on a stock, and if you looked at the weekly 7-period RSI, and if it was above 50, then the trend of that stock to me is up.
So you're looking at the next higher time period, same indicator, to give you the trend variable.
Right. And then also I'll incorporate that into the daily bar as well, in that I'd like to have both of them be above 50 is what I'd want to have. So you've got the trend of the two time periods going your way for our entry signals. Okay. It'd be really nice if a market just went from A to B and there was no backing off and filling, no consolidations, but that's not what happens. Often markets, they zigzag, and they'll have movement that can range between one point here and another point here, and we don't know how far any of these pullbacks are going to happen. But what I do is I outline a range using Fibonacci ratios to watch for support levels in a bull market. For example, let's look here at the daily bonds here, just going back for this last month. We had this upward leg from here to here first off, and then this line is the 38% retracement of that swing. This next line is a 50% retracement. The next line is a 61% retracement, and the next line is a 75% retracement. What I do is establish a, let's see, how can I word this? A length of a move, and I'll explain to you how that's established first, and then I plot these various Fibonacci retracement levels. It turns out in this case, this last 2 weeks, the bond market has been so strong that it only touched the 38% retracement level. That was quite a positive sign about this. Well, now then, how would we decide what points do we want to be making our retracements from? I use another technique that Robert has already introduced. We call them isolated highs and isolated lows. And this is the similar concept. This is an isolated low. It's a period where there's been 3 bars that represent a selling has basically ran out. The 3 bars where you have the low here and you have a higher low on both sides. Here's an isolated high. We have this spike up in here, and we have 2 highs, one on both sides of it that are higher. So as soon as I see that I have an isolated low and an isolated high, I now think that this degree of this trend is completed, and I would immediately plot these retracement levels to watch for potential levels of support for a pullback. Now, and I'll get into this because when I was, we'll get into some rules here in a moment, But in the old days, I used to really get bothered by people who would always say, look how it stopped right at the 38% retracement level. Isn't that wonderful? And I'd say to myself, well, did you know that it was going to stop on that day? I mean, what if I would have bought and it went down to the 61% level retracement? Are you going to show me 2 weeks later, look how great it was that it stopped at the 61% retracement level? Well, my rules will give you some reasons to decide whether or not you're going to act after the market has hit any of these particular levels. So if that's something that you too have also wondered how people make that decision, we'll be getting to that in a point. Okay, so we have established at this point the trend on own time period, RSI being above 50. We have the trend on the next higher time period for uptrends being RSI greater than 50 or downtrends RSI being lower than 50. And we've now given ourselves some levels to think about trying to buy the market if it's in an uptrend. Here I've got two charts. The left-hand chart is this daily bar chart with showing the RSI is plotted along it. As you can see here, the RSI is actually spending most of its time right around this 60 level. So those are that's a very strong sign that this market is in an uptrend. And as we recall from the previous chart, this is a 38% retracement level. Now this is the next time period for our trading guidelines. This is going to be a chart for an example if we were trading intraday. So we have this setup where the daily bars have come down, or the RSI is greater than 50, and we happen to know as a backup that the market held at the 38% retracement level. Now, going to the 17th, which is actually, I believe, this bar right in here, we have this gap down. I drew in, let's see here. Oh, there's another thing I want to talk about. Okay, I don't have the chart for that, but I'll explain this to you. If you recall, on the isolated highs and isolated lows, I said once you have an isolated high and an isolated low established, we can then establish, this is our high here, isolated low. We can then establish our point for our retracements. Well, let's say that the market rallied to here and then took out this isolated low. If that happens, we now want to count back 3 isolated lows for our retracement levels. And the reason I do that is because if the market takes out this first isolated low, we now, I believe, are correcting a trend of a larger degree than what this isolated low and this isolated high is a part of. And this shows up on this intraday chart that I'm going to go back to now. Sure. Actually, I'm going to show you here. If the market forms an isolated low after your last isolated high and you're thinking about buying, like if you look here closely at this right here, see here's an isolated low. And the market here takes out that isolated low. We can no longer use this isolated high and this isolated low for our retracement measurement, because the market is looks like it's going to correct more than just this level here, which in fact it does. So I count back 3 isolated lows from the peak of the market. So here's the first one, is this one right here, 1, and then 2, and then 3. Because to me, once that isolated low was taken out, it's correcting a greater degree trend than just this move. So I would redraw my retracement levels from this point here down to this point. So now we've established various retracement points for us to watch for the market to get to. Now, as you can see, on the 17th, we opened clear down here, and the RSI plummeted all the way down to 40, excuse me. So it broke our 50 level, but however, it did hold the 40 level. And if you recall, I said that in bull markets, 40 on RSI is oversold. And the fact that as a backup, we have the daily RSI is above 50, we consider the trend to be up. I would wait until the RSI crossed back above 50 here to be a buyer of this market. Now you can go ahead and wait until you get a close above 50, or you could put a buy stop in over the bar that caused the close of 50. Is everybody with me still on this part then?
Was that just an arbitrary, what made you arrive at the idea of going 3 lows back instead of 2 or 4 or 5?
Well, my work in the Elliott wave world, which I'm not advocating as a trading method because it's so difficult to get it into a mechanical program or a mechanical plan of action, because in Elliott wave there's just so many alternative counts. But when an Elliott wave cycle begins to correct, it will often pull back to a 4th wave of a smaller degree. So I just kind of, through trial and error, thought in those terms that if we're correcting more, that would mean that I would probably count back a certain amount of isolated lows in this particular case, or isolated highs. And I came up with that 3 number, and it seemed to offer the most consistent sort of approach. So it wasn't really, you may find something that works better, but I found that this works pretty effective for me on where to draw the retracement levels from. Because again, I'm trying to turn this into fixed rules where I'm not going to be hedging. And what will also happen is that if you were to have a different one, chances are you're going to get back into these Fibonacci zones anyway, and so that criteria being met is not, isn't going to be quite as important. Go ahead.
How would you define what an isolated low and an isolated high are?
Okay, an isolated high, you have a center bar and you have lower highs on both sides of it. And an isolated low is the opposite. You have a low point and then you have a higher low on both sides of it. Right. Right, and so that represents the isolated low and then an isolated high. And then once those are established, I would then put in my Fibonacci retracements. If my RSI on the higher or the next time frame was above 50, I'd be looking to buy. As long as the RSI on the own time period, held in that 40 level, and then wait for it to buy once it crosses 50 again. You may say to yourself, well, why not just, why do you really need that? Why not just trade those RSIs? I like the use of the Fibonacci retracements because it really kind of forces a discipline upon me to wait for that consolidation that almost always happens. That is, as long as I wait for a minimum of 38% retracement of the trend, chances are I'm not going to be buying too early. So that's why I include these retracement points. So in this particular case, the market went back above the 50, and momentum for the day continued to be strong and closed, went on to take out the previous high. Now another technique that I also like to use, if I can, is I like to include placing some trend lines. Did I hit a button? I've lost my chart. Okay. Here again is some intraday bars using 40-minute bars. I really like it if the market's in a trading range like this, that I can draw some sort of a trend line as an additional backup tool. In this particular case, this is also the same time period that we've been a little bit earlier, where the daily bar RSI was above 50. On an intraday basis, it dropped below 40 in here on this trend down. However, the market took out a trend line, and then at this point when it crossed 50, you could have been a buyer again. So I like to just use trend lines as an additional backup tool, that if the market is in some sort of a trading range and then takes out some sort of a downward trend line in an uptrend, I really like to use that as an assistant in helping myself spot these trades. Okay, so this is an entry guideline that we've established here. And here's an example of this 1, 2, 3 use happening. Once on this bar right here, when it took out that isolated low, I immediately counted back 3 isolated lows to draw my retracement. Okay, so these are entry ideas. What do we do about exiting? I use a similar technique of going, I take, in this particular case, this is back to the 17th where we had our buy-in here. And I too recommend what Robert recommends in that you trade multiple contracts. And in this particular case, because what happens in here is if you were to buy 3 contracts on this day, I recommend taking off 1 contract on a 61% retracement of this most recent trading range. That is, if you look at the market bottomed here on this day and the most recent high was back up in here, the previous day's high, or that day's high, I would take off 1 contract as soon as the market gets above 61%. Now the reason I recommend doing that is it puts a little bit of money in the bank, it reinforces you for doing your trading, and you never know, the market may just come up here and stall and actually be locked in a trading range and possibly reverse. So at least you put something away. The second contract I would take off then was back at that old high. That is, if the market got up to that old high, I would sell the second contract. Now you're being more like the professional trader who's buying support and selling resistance. The market may go on through. You'll still have 1 contract on. All you would need to do is then use a trailing stop. There's a number of really good tools in the Fibonacci trader for using as a trailing stop. The dynamic tree low, the high-low activator, which you'll learn more about. And so those are your profit-taking rules. For your stop loss rules, what I would recommend using is the low of the bar, if it was a buy signal that you got stopped, that you went into, could be your tightest stop. And you could take off 1 contract there or all contracts if the market broke down and the RSI turned back below 50. Or if you wanted to, you could risk to the previous bar, the previous low of this move. That's another place. But you have to have some sort of a stop loss in there. So you never want to trade without something along those lines in there.
Question.
Sure.
In the bonds on the 40-minute, how many ticks below the low will you put your stop at?
At least 2, because you never know you'll get that 1 tick, trade below there. So, okay. To summarize again, then, the trading is a process of preparation. If you're trading the daily bars, you could, and using RSI, you can learn the formulas and you can put them into a spreadsheet and do a what-if scenario. When I was a broker at Drexel Burnham, one of my bigger accounts wanted to know every day what levels were the 60% on a closing basis and what levels were going to be the 40%, so that she knew that if the market, if she was bearish and the market seemed to be struggling throughout the day around the 60% level prior to the close and was going to close down from that level, that was information to her. Whatever indicators you're using, you should be able to learn how to calculate them mathematically so that you can do a what-if scenario for the next trade's trading, so you can actually have a sheet available for you to give yourself the important levels so you don't have to think about this stuff during the heat of the trading day. Again, specialization. You don't want to be an Elliott Wave trader one week and a Gann trader the next week and trading moving averages the following week after that. And finally, it's execution. Once you have your trading plan thought out and that you have tested it and you're very convinced about it, have a great deal of confidence in it, then you're really ready to trade using the technical trading plans. That's all I've got then, so, okay.